Yesterday, the market showed you fear. Today, it shows you the truth. For a few brutal hours, silver collapsed. Screens turned red. Headlines screamed. Social media panicked. And somewhere in that chaos, millions of people were pushed to the same decision: sell now or suffer more. That moment wasn't an accident. It was designed. Because when silver fell, nothing fundamental changed. Mines didn't close. Factories didn't stop. Demand didn't disappear. Only one thing changed: emotion. Fear was injected into the system, fast and violently, to force weak hands out of their positions. Stops were triggered. Margin was wiped out. And right when the selling reached its peak, the engines reversed. Now look at the screen. Silver didn't just recover. It snapped back. Hard, relentless, almost insultingly fast. This wasn't a correction. This wasn't a breakdown. This was a trap. And if you are still here, if you didn't blink, then you weren't at the target. You were the test. Let's expose exactly what happened and why this crash may be the most bullish signal of the entire year. This was not a random collapse. It was a deliberate operation. Markets do not simply fall this fast without a reason. What appeared to be panics was, in truth, a calculated liquidity flush, one of the oldest and most effective tactics used by large market players to reset positioning. The goal was simple: force weak hands out of the market and extract liquidity at scale. The setup was textbook. Price hovered near widely visible support levels. Everyone saw them. Retail traders placed stop losses just below those zones, believing they were protected. But those stops weren't protection. They were targets. Once price was pushed slightly below support, it triggered a chain reaction. Stop losses fired, margin calls followed, forced selling accelerated, fear did the rest. Social media turned instantly bearish. Headlines amplified the narrative of collapse. Retail traders didn't just sell, they rushed for the exit, convinced something had fundamentally broken. That emotional reaction is not a side effect of crashes. It is the objective. Large institutions need volume to enter positions. They cannot buy quietly when prices are stable. They need chaos. They need sellers. And the fastest way to create sellers is to manufacture uncertainty and fear. This is why crashes often feel sudden and irrational. Behind the scenes, nothing was irrational. It was precision timing. Liquidity was thin. Sentiment was fragile. And once the first level broke, the selling fed on itself. The market wasn't discovering new information. It was being forced to release trapped liquidity. And here's the critical detail most people miss. The selling pressure did not come from institutions exiting positions. It came from retail traders being pushed out of them. Volume patterns show the truth. Distribution never occurred. Instead, accumulation quietly began as prices fell. This is how modern markets transfer wealth, from emotion to patience. The crash created the illusion of weakness. But illusions are powerful. They cause people to act against their own interests. By the time fear peaked, the damage was already done, not to the market, but to confidence. And when confidence collapses, opportunity is born. What followed wasn't a miracle recovery. It was the natural result of engineered conditions. Once liquidity was absorbed and selling pressure exhausted, there was no reason for price to stay suppressed. The flush had served its purpose. Weak hands were gone. Positions were reset. Control returned to those who understand the game. This wasn't a market failure. It was a market function. And for those watching closely, the message was clear. The crash wasn't the end of the move. It was the beginning of the next phase. The speed of the crash shocked everyone, not because markets have never fallen before, but because this fall had no human rhythm. It didn't breathe. It didn't hesitate. It accelerated without emotion. That's the signature of algorithms. In today's markets, humans don't control momentum. Machines do. Once price slipped below key technical levels, a silent army of momentum-based trading bots activated instantly. These systems are programmed to react, not reason. They sell when volatility spikes, when trend lines break, and when order flow turns one-sided. In milliseconds, sell orders cascaded through the system, faster than any human could respond. What might have been a controlled pullback in the past became a violent freefall. Algorithms don't see value, they see signals. As selling pressure increased, other bots joined in. Volatility targeting funds reduced exposure. Risk parity models rebalanced, and high-frequency traders withdrew liquidity entirely. Bid-ask spreads widened. Depth vanished. Every market order pushed price lower than expected. This is why modern crashes feel exaggerated. Liquidity disappears at the exact moment it's needed most. But here's the part few people understand. Algorithms don't have loyalty to direction. The same systems that magnify downside are designed to reverse instantly once selling pressure is exhausted. When volume spikes without follow-through, when downside momentum weakens, when price stabilizes, the code flips. Selling becomes buying. And because these systems operate at machine speed, rebounds are just as violent as the crashes that precede them. This creates the illusion of chaos. Sudden collapses followed by sharp recoveries that leave human traders confused and emotionally drained. Retail investors feel betrayed by the market. But the market isn't emotional, it's automated. The turning point always comes when humans are most convinced that this time is different. When fear peaks, algorithms detect exhaustion. Short positions pile up. Liquidity returns. Buy programs activate. This is why the rebound often begins before the news improves. By the time headlines turn optimistic, the move is already underway. What looked like a loss of control was actually a transfer of control from human hands to machine logic. And machines don't panic, they execute. Understanding this changes everything. It explains why selling feels unavoidable at the bottom, why bounces feel impossible to catch, and why those who hesitate are left watching from the sidelines. The crash wasn't accelerated by emotion, it was weaponized by code. And once the algorithms flipped, the fall that felt unstoppable suddenly reversed, with equal force. That's not randomness. That's the modern market at work. While screens flashed red and fear spread across social media, something very different was happening beneath the surface. Institutions were buying, not emotionally, not impulsively, but methodically. This is the fundamental divide between retail investors and professional capital. Retail reacts to price, institutions prepare for it. Long before the crash unfolded, large funds understood the conditions forming beneath the market: fragile sentiment, crowded positioning, and thin liquidity. They weren't surprised by the drop. They were waiting for it. When prices collapsed, retail investors interpreted it as a warning. Institutions saw it as an invitation. As sell orders flooded the market, accumulation quietly accelerated. Large block trades appeared. Dark pool volume surged. These transactions don't show up in headlines, but they leave fingerprints in the data. While retail panic intensified, smart money stepped in, absorbing supply without drawing attention. This is not speculation, it's structure. Institutions cannot build positions at market highs. Their size makes that impossible. They need volatility. They need forced sellers. And crashes create both. Every retail stop loss hit, every margin call triggered, every emotional exit provided liquidity for professionals to enter. This is why the volume profile during the crash tells a different story than price alone. Selling pressure looked extreme, yet price refused to collapse indefinitely. That resistance wasn't hope, it was absorption. Someone was buying everything being thrown at the market, and it wasn't retail. What makes this process invisible is patience. Institutions don't chase rebounds. They don't post on social media. They don't announce entries. They accumulate in layers, allowing fear to peak before committing fully. By the time retail investors conclude that something is wrong, positioning is already shifting. The narrative turns bearish, just as the transfer of ownership is nearing completion. This is the quiet part of the cycle. The panic phase doesn't end when fear disappears. It ends when there is no one left to sell. Once that happens, downside momentum stalls. Price stabilizes, volatility contracts. Then comes the reversal. And when price begins to rise again, retail investors are confused. They sold for safety. Yet the market moves higher without them. That's not manipulation, that's consequence. Markets reward preparation, not reaction. The crash wasn't a signal of institutional exit. It was evidence of institutional entry. Positions that took weeks to plan were filled in hours. Capital that waited patiently finally deployed. And once that process was complete, the incentive shifted from suppressing price to allowing it to rise. This is why recoveries often feel unfair. Because by the time confidence returns, opportunity has already passed. The panic didn't damage the market. It reset ownership. And once institutions finished buying, the direction of least resistance changed, from down to up. While headlines screamed collapse and charts showed violent red candles, the most important part of the market remained completely calm. The physical market never broke. This distinction matters more than price itself. Paper markets, futures contracts, derivatives, and leveraged instruments react instantly to fear. Physical markets do not. They respond to supply, demand, and scarcity. And during the crash, scarcity never disappeared. As paper prices plunged, physical premiums held firm. In some cases, they even rose. Dealers didn't slash prices. Supply didn't flood the market. Buyers didn't vanish. That silence was not weakness. It was confirmation. Because when a market truly breaks, physical demand collapses first. That didn't happen. What occurred instead was a disconnect between paper price and physical reality. Futures contracts reflected panic. Physical assets reflected restraint. This divergence exposes a structural truth. Paper prices can be pushed temporarily by leverage, algorithms, and forced liquidation, but they cannot override real-world demand indefinitely. This is where manipulation reveals itself. Paper markets are designed for speed and speculation. They allow large volumes to trade without the movement of a single physical unit. That makes them efficient and vulnerable. When liquidity is flushed and leverage unwinds, prices can fall far below fundamental value. But physical buyers are not leveraged. They don't trade on margin. They don't respond to 5-minute charts. They wait. During the crash, physical buyers recognized what was happening. They understood that the selling pressure was artificial, driven by forced liquidation, not genuine oversupply. So they held their ground. No panic, no discounting, no surrender. That behavior sends a powerful signal. It tells us the floor wasn't broken, only obscured. In past cycles, this exact pattern has preceded major reversals. Paper markets collapse first. Physical markets refuse to follow. Eventually, paper prices snap back toward reality, often violently. This is why the physical market acts as an anchor. When paper prices detach too far from physical demand, tension builds. The longer the divergence lasts, the more powerful the correction becomes. Markets can ignore fundamentals temporarily, but never permanently. And that's what made this moment so revealing. The crash created the illusion of systemic weakness. But beneath the noise, the foundation remained intact. Physical holders didn't blink, supply chains didn't fracture, demand didn't evaporate. The market didn't fail. It exposed the difference between illusion and substance. When price began to stabilize, it wasn't because fear faded, it was because reality reasserted itself. Paper markets had pushed too far. The disconnect had reached its limit. The physical market drew the line. And when that line holds, history tells us one thing with remarkable consistency. The rebound isn't gradual. It's corrective. Because once the illusion collapses, price doesn't drift back to fair value. It snaps. Markets don't move in a vacuum. They move on incentives. And as the calendar approaches year-end, those incentives change dramatically. December is not just another month. It's a deadline. Performance is measured. Books are closed. Statements are printed. For funds, institutions, and asset managers, perception matters almost as much as profit. Underperformance must be corrected. Exposure must be adjusted. And narratives must be shaped before the clock resets. This creates pressure, and pressure creates behavior. Funds that lag benchmarks are forced to act. Sitting still is no longer an option. Capital that remained cautious during the year suddenly needs results. That urgency often expresses itself as aggressive positioning into year-end, especially after a sharp correction. Liquidity during this period is thinner. Many participants step aside. Volume decreases. And when liquidity thins, price becomes easier to move. Smaller flows can create larger effects. That's not coincidence. It's structure. This is where manipulation thrives. Pushing prices higher into year-end serves multiple objectives at once. It improves performance metrics. It enhances year-end reporting. It attracts new capital in January. And it rewards those who accumulated during the crash. The sequence is familiar. First, fear forces weak hands out. Then, positions are built quietly. Finally, price is allowed, or encouraged, to rise. Year-end provides the perfect cover. What makes this process difficult to see is that it doesn't require conspiracy. It requires alignment. When multiple large players share the same incentives, their actions naturally reinforce one another. Buying begets buying. Momentum feeds on itself, and the narrative follows. Bearish headlines begin to soften. Analysts revise outlooks. Commentators speak of resilience and unexpected strength. By the time optimism returns, price has already moved. This is not accidental. Funds understand psychology. They know that markets respond to expectation as much as data. A rising market into year-end shapes sentiment for the year ahead. It conditions investors to expect continuation, not collapse, in January. That expectation becomes fuel. History supports this pattern. Many powerful rallies have begun in the final weeks of the year, not because fundamentals suddenly changed, but because positioning did. The groundwork was laid during the panic. The execution came during thin liquidity and shifting incentives. This is why year-end moves often feel artificial. They are, but artificial does not mean unsustainable, at least not in the short term. Once momentum takes hold, it pulls in sidelined capital. Those who sold during the crash feel pressure to re-enter. Shorts are forced to cover. The move feeds itself. By the time the calendar flips, the market has already chosen its direction. Year-end isn't the end of the story, it's the setup. And those who understand this aren't asking whether prices should rise, they were watching how incentives make it likely. When markets snap back after a violent drop, the question is always the same. Was it temporary or a trend reversal? Yesterday's crash screamed panic. Headlines painted disaster. Retail traders sold at the bottom. Margin calls forced exits. Fear was everywhere. But today, with silver surging back above $74, a deeper truth emerges. The bull market never died. This is the essence of a failed breakdown. Technically, price broke support. Traders expected continuation. But when the market refused to fall further, when it bounced violently, a signal was sent. It is subtle yet powerful. The weak hands are gone. The market has tested its floor and passed. This is a classic bullish hallmark that professional traders watch for years, yet few recognize in the moment. Institutional support is the key. Hedge funds, pension funds, and smart money buyers didn't just enter the market, they accumulated aggressively. They waded through the panic, absorbed selling pressure, and positioned themselves for a rebound. This is not random, it is calculated. Banks and major funds know the psychological trap that volatility sets for retail investors. By allowing the initial crash, they separated the fearful from the committed. And now, the committed remain. These strong hands are the foundation of a sustainable bull run. Algorithms add a layer of drama. CTA bots, programmed to chase momentum, exacerbated the fall. But as the rebound began, the same machines flipped to buy. Shorts were covered. New long positions opened. The result is a double-layered surge, an acceleration fueled by both human and machine psychology. Charts show vertical green spikes, but behind them lies a coordinated structural pattern. Short covering, institutional accumulation, and renewed optimism. But this is more than technicality, it is emotional. Markets are living systems of human behavior. Fear, greed, relief, and anticipation interact continuously. Yesterday, fear dominated. Today, relief and conviction dominate. Retail traders who held through the storm experience what veterans call a bull confirmation. They are no longer tentative, they are believers. This emotional shift amplifies buying momentum. Long-term fundamentals align. Industrial demand for silver remains high. Mine supply is constrained. Global macro pressures, currency devaluation, geopolitical uncertainty, and inflation support tangible assets. Every metric points upward, and the failed breakdown confirms that the market itself acknowledges its intrinsic value. As we move into January, the implications are clear. Volatility will remain, but the trend is upward. Those who understand the failed breakdown are positioned for the next leg. The market tested its weakness, found none, and now signals strength. This is the hallmark of an enduring bull market. The message is urgent. The crash was a test. The market passed. Now the stage is set. The bulls are alive, and those who held or who enter wisely in the coming days are poised to reap the rewards. The countdown to higher prices has begun. The market trembled yesterday. Silver fell through key support. Panic spread like wildfire. Margin calls hit. Weak hands sold. Fear ruled. But today, something extraordinary happened. The price didn't just recover, it exploded back above 74 $. This is not just a rebound. This is a declaration. The bull market is alive and in control. This is the textbook case of a failed breakdown. Technically, the market broke support. Everyone expected more pain. But when it refused to stay down, it exposed the lie. The sellers were gone. The market tested the floor, and now the strength is undeniable. In trading psychology, this is a powerful bullish signal. The weak hands have been weeded out. Only the committed remain. Behind this, the institutions are orchestrating the move. Hedge funds, pension funds, and smart money buyers are stepping in, absorbing every ounce of panic selling. They are building positions quietly but massively. This isn't random, it's strategic. They know the psychology of fear. They know retail panic fuels liquidity. By letting the market dip, they created a vacuum for accumulation. Now the rebound is fueled by the very pressure they engineered. And then there are the algorithms. CTA bots chased the fall yesterday. Today they chase the rise. Shorts are covered, new long positions are opened. The result? A double boost. Mechanical buying layered on top of human conviction. The charts show sudden spikes, but beneath it, the market is reasserting structure. The bulls are winning. The trend is clear, but it's more than numbers. It's human emotion. Retail traders who survived yesterday are no longer fearful. They are confident. Relief is turning into conviction. When the collective sentiment flips, it magnifies the rally. Every buy adds fuel. Every hold strengthens the floor. This is how enduring bull markets are born. Fundamentals support the story. Industrial demand is high. Mine supply is tight. Global macro risks, inflation, currency devaluation, geopolitical uncertainty push investors to tangible assets. Silver is the safe haven, and now the technicals agree. The failed breakdown confirms that market structure and fundamentals are aligned. Looking ahead, volatility will persist. There will be dips. There will be spikes. But the trend is now bullish. The market has tested its weakness and found none. Those who hold or enter strategically are positioned for massive gains. This is the phase where the patient are rewarded. Yesterday was the test. Today, the market passed with flying colors. The bull is awake. The countdown to higher prices has begun. Every ounce held, every position maintained, every patient investor now stands on the threshold of the next leg upward. The story is far from over. The next chapter will define the year.